Hey guys, Brian Stevens here with National Real Estate Post and Mortgage Shots. Listen, if you'd like to look at a fundamentally different way of building your business as a loan officer, I'm going to be having a webinar next Wednesday at 1 o'clock Pacific Standard Time. It's how I build my business, getting back into the industry and working with my team. A lot of crowdsourcing taking place. If you want to be a part of it, fill out the information down below and I'll make sure I get that link over to you. And yes, it's going to be interactive and should be very interesting. Again, 1 o'clock Pacific Standard Time. But anyways, I want you to look at this. This is a graph here, and what it says is, if an item was worth $1.1790, what would be the equivalent value in today's money? Now, this goes back to 1790, where we get $1. Now, you can tell the War of 1812, we saw inflation go up. Makes sense. We saw the 1837 panic. We saw the Civil War, and we could see World War I. That is where the Federal Reserve came in, and look at what happened to inflation. It freaking went through the roof. It's everything in that bluish purple. I mean, it's nuts. So inflation is down now, but relative to your Eris dollar, we are paying way more for everything than we ever have. I mean, it is night and day, and the only common denominator is the Federal Reserve. So that is supposed to control our money supply or manipulate our money supply to make things better for us. Has it? Absolutely not. Emphatically worse. In fact, when we hear inflation has gone down and things are better now, we aren't even in the same ballpark. We are not playing the same damn sport as what we played back in 1910. The Federal Reserve manipulation of our money supply as it pertains to inflation has made everything, including housing, wildly more expensive. Now, according to the Daily Mail, there's chilling signs right now that a housing crash is underway as sellers panic, cut price at the highest levels that we've seen in 13 years. I'd like you to look at this graph. What this shows is 1 in 7 sales is falling through right now. That is a wildly high number, something we haven't seen in years. If you look at this graph here, you can see we're failing at a 13.7% rate right now. And of course, if we go back to 2023, 24, 25, and 26, these are all higher than any previous year. And of course, if this graph were to go past 2017, we would see that the number of transactions that fell out or significantly lower. The reason is very simple. Buyers think that there's better opportunities tomorrow than they're going to get today, and frankly, very few could argue with them when you consider the shadow inventory that we have, particularly with our Ginnie notes, those Fannie, Freddie, and USDA loans. The article goes on to say, new Redfin data shows that buyers now in control confidently forced sellers into deep discounts on home prices. In fact, those who talked sellers down typically walked away with 8% off, and that is the steepest cut that we've had since 2012. Which, by the way, if you're counting, was the tail end of the last massive once-in-a-lifetime housing crash. So how big is that cut? Well, it translates into roughly $31,600 in savings based on last year's median list price of $399,000. Across the entire market, including buyers who paid full price, the average discount still came down to $15,200. And if you look at this map of the United States, you can see all those purple dots, and the size of the purple dots denotes a buyer's market. The blue dots, which are very few in between, denote a normal market, and the very seldom found red dots is still a seller's market. In short, all the purple dots on this graph of the United States would suggest to everybody that we have completely and totally shifted away from a seller's market over to a buyer's market. And this, of course, is reflected in what I told you a couple of days ago, and that's that we have 44% more sellers than we have buyers, and that number continues to grow. Hence, sellers are starting to get nervous, and that's why, on average, we're seeing 8% below asking price across the board on your average house. Don't go in full price on a property, and I'll tell you right now, a lowball offer, you might be surprised. It could get accepted. I know all you love AI, especially in the real estate and lending community. I think this is really predominant with our middle-aged guys and gals out there. You know, those over 40 to the 60 range, we think AI is going to be the end-all. Surprisingly, who doesn't like it are the younger generations. But anyways, are we going to see an AI bubble because we are way too dependent on it right now? Well, this you might find interesting. Job postings for software engineers are going through the roof right now. Now, you remember, AI is going to kill who first? The software engineers. Yet, if you look at this blue line, that is Indeed job postings for software engineers. It's gone through the roof. It has literally tripled since May of 2025, suggesting that AI might be a little bit too hyped up right now. The truth of the matter is, your clients want to talk to you, and as much as you think AI is fantastic right now, if you have bots replacing you, nobody wants that, including your peers between that 40 and 60 age. Rely on your actual intelligence more often. Don't necessarily rely on that artificial intelligence. And finally, I stumbled upon this site, and I think it's just kind of cool. It's called TrendyZip, TrendyZip.com. Don't know the guys at all, but this is kind of cool because they aggregate zip codes. So if I go into TrendyZip.com, then I put in my hometown of Vacaville, California, and hit go, then it's all free. I can tell that Vacaville, the south side, goes for $328 per square foot, where the desirable north side goes for $360 per square foot. In short, there's not a lot of deviation where I live. Now, if I put in Oakland, California, this becomes very interesting. You can see one Oakland zip code goes down to $378 per square foot, even cheaper than little old Vacaville, but that same city of Oakland in another zip code goes for $1,027, nearly quadrupling, meaning Oakland is truly a tale of two cities. Now, I also popped in Lexington, Kentucky, and you can see we go down as low as $153 per square foot up to $224 per square foot. I think what's really helpful is this. If you have investors who are looking at getting into properties on the lower side of the price point, you're going to have a lot of room in different zip codes in different cities. Now, unlike Zillow, this isn't trying to steal your clients away, but if you need a reason to reach out to your past client database, or if you are somebody who's looking at buying a house, if you go to TrendyZip and put in some zip codes or cities, you can find out what the deviation between the highest and the lowest points in that market are, not only for investing purposes, but because we have unaffordability, which is coming back, right? It's coming back, but because it's still unaffordable where your median average first-time home buyer cannot buy the median average house in any community, what you might be able to do is find some zip codes that meet your price point, and of course that might get you in the home owning business rather than the home renting business, and we all know it is infinitely better. So you guys make it a great day, and I will catch you on Monday.